I wanted to share an announcement. There's a lot of people who miss out on real estate opportunities because they don't know what's happening in the real estate market or how it impacts them. And so I'm excited to announce we've created a new show that's dedicated to teaching people about what the real estate market's doing, how to find opportunities, and then also sharing proven, actionable strategies so you can buy and sell real estate with confidence. And the show's called Know the Market with Dan Del Real, and we're bringing you content every week. So however you like to consume content, whether it's through a webinar, video, podcast, blog post, you can go to dandelreal.com to learn more about what we're doing and also get connected with that content. There's a link there to subscribe to our YouTube channel, follow us on social media. And so I'm excited to continue to bring you content week over week. We're going to go ahead and get started here. And so I'm excited to have Geraldine Serrano as a guest today. The first time I heard Geraldine speak, she got my attention because, one, I immediately saw the huge potential to the clients that I'm helping. And then the other thing was I wanted to really listen closely to wrap my mind around some of the concepts and strategies that Geraldine was sharing. And so Geraldine has some great information to share with us. We're also going to do a Q&A. So if you have a question, type a capital Q in the chat room, and we're going to be scanning that throughout the show, and we'll get to those questions later on. But welcome, Geraldine. It's good to have you.
Yeah, and thank you for having me. I'm always looking to educate real estate owners out there. So thank you for having me.
Definitely. Yep, definitely. Thank you for being here. And so why don't we start by telling us a little bit about yourself and what do you do, Geraldine?
Sure. So I was born and raised in the Bay Area. So I work and live in the East Bay. My company is nationwide. So I have clients and connections all over the country. However, especially with the connections that I have here in the Bay Area, they don't necessarily own property in California. They may own out of state. So I'm glad that my company is able to take care of my clients anywhere in the United States and any of the properties that they own across the US. So, I love being in the Bay Area.
That's great.
Yeah.
So out of the Bay, but you're doing business all over the place. And then you were talking a little bit about your clients. So who are your clients? What kind of people are you helping?
So I help two groups of people. I help real estate owners that own either residential or commercial real estate. And I also help tenants that own their improvements. And so a perfect example would be, a restaurant or let's say a CVS that has built out the space inside of a building. So, and I also work closely with their CPAs because with the work that I do, it helps those two groups reduce their tax liability, which increases their cash. But we don't do, so my company, Veracity, is a specialty tax firm. We don't do our clients' taxes, but we do work with the CPA to help them reduce the client's tax liability.
Got it. Okay. So I think the first time I heard you speak, it was at a commercial real estate event. So I kind of had my commercial broker hat on, but it sounds like in addition to commercial, you also work with some of your clients own residential property, and then you're also helping the end user tenants. And then the way that you do business, you partner with CPAs. So you really kind of take a team approach to meeting the needs of your clients. Is that right?
Yes.
Okay.
So,
okay.
And just because you brought that up, so this engineering study called cost segregation that we do for our clients, it works on any residential and commercial property. The only property it doesn't work on is a primary residence. So on the residential side, as long as it's a rental, we can do this cost segregation study on a single family home, a condo, a duplex, a fourplex, or an apartment building. So it's not just for commercial.
Okay, that's great. That's great. And when you're working with clients, at what, I guess, when do they come to you and meet with you? Is it after they when they're getting ready to buy a building, after they close escrow? Are they coming to you while they're kind of holding real estate? And what do they want? What does kind of that initial interaction look like?
So I get introduced to clients either before they close on a property or after, or if they are introduced to me and they've owned properties for a certain amount of time. So when I get introduced to a client before they purchase a property, they just want to know what the tax benefit they might receive from doing a cost segregation study. So it's more for tax planning purposes, right? So they would have a conversation with me just so that they could see how much of a tax benefit they would receive. They also, I may get introduced to them after they've closed on a property, and then, because after they own the property, then they can do this cost segregation study and reduce their tax liability. Also, going back to, I may be brought in before they close on a property. If we're talking about a 1031 exchange, the reason why they would be introduced to me during that process, is because with the rules, with the 1031 exchange, the client would want me and my firm to do a cost segregation study on the property that's going to be relinquished. And then they're going to want me to do a cost segregation study on the new property, just to maximize the tax benefit they would receive on having a study done on both properties. Because otherwise, if we're just looking at the new property in that 1031 exchange, they're going to be limited to how much of a tax benefit they would receive, versus if they had done it on both properties. So that's another reason why they would bring me in during that 1031 exchange process. Also, estate planning attorneys or CPAs would bring me in if there's a death in the family. So even if the deceased did cost segregation on their real estate, the depreciation clock restarts for the heirs. So once the step up in basis happens, then the heirs can do a cost segregation study because that depreciation clock restarts for them. So those are some of the different scenarios and when I would be brought in.
I see. Okay. So it sounds like sometimes there's events, someone's usually looking for ways to save money or looking for tax benefits attached to real estate. And then, but it also sounds like sometimes it's not event driven. Someone just might own a portfolio of real estate or a property, and they're looking for some tax benefits that they could take advantage of. Sure.
So I'll get introduced to clients that have real estate portfolios. And the reason being is if they do owe the IRS, then they're looking for different tax strategies that will help them reduce their tax liability. And when a client has a portfolio, they're able to, depending on the circumstance, they're able to pick and choose which properties would help them reduce their tax liability. So they may not do a cost segregation study on all their properties. They may just pick and choose which ones would make sense for them at that time.
Okay, that makes sense.
And also, I wanted to go back and talk about another situation where I would get introduced to a client. Also, when you were talking about the timing of it, a lot of times the best time to introduce me to a client is before they purchase the property, so that and they're talking about their tax strategy and their planning. If they're going to be doing renovation on the property, then it's good to have a conversation before, well, it could be before they purchase the property, but definitely after they purchase the property and before they do any renovation. Because because what will happen is, ideally they would want to bring me in right after the purchase so we could do a study and capture the tax benefit on the property as it is. And then after they do the renovation, we would come back and do the second part of the study to capture the benefit they would receive on all the improvements that they've done to the property. And also, just to maximize the tax benefit, when there's a renovation involved and there's going to be disposed assets, right? You're going to throw away the flooring, put in new floors, or you're going to throw away the decorative lighting and put in new lighting. Then the IRS says that you can write off the remaining basis of those disposed assets. So the reason why it's important to bring me in before the renovation to maximize the tax benefit, because when I get introduced to the client and they've already done the renovation, we can't go back and do a cost segregation study on what was there before the renovation. And then definitely what would be called partial asset dispositions, where you would write off the remaining basis of those disposed assets. That opportunity is out the window because they've already thrown away those items. So that's why it's important, either before or right after the purchase, for me to have a conversation with the client.
Okay, so in that scenario, someone could literally be throwing money in the garbage.
Correct.
Okay, so that's good to know. We definitely don't want to do that. And then, so if I'm hearing what you're saying correctly, it sounds like if there's an event-driven, if there's something happens, whether someone's buying a property or if they're getting ready to renovate, it makes a lot of sense to have that consultation on the front end, so they could potentially save a lot of money.
Correct. And I'll give you a recent example from a client that I worked with this year. I got introduced to a developer that constructed a commercial building out of shipping containers. So I got introduced to this developer after he constructed this building a few years ago. Now, there were a couple of things that came up that, had I talked to him before he constructed that building and during the planning process, then there would have been a couple of things that he would have known. It might not necessarily have changed his plans for this project, but at least he would have been aware of the tax benefits that he may get if he designed the building a certain way. And what I mean by that, one, so with these shipping containers, the question that came up is, how did he attach them? Did he weld them together, or did he attach them with nuts and bolts? And it becomes important because with this engineering study, what it does is it separates the real property from the personal property, right? So real property is anything that's permanently attached to the ground, okay? And so with a commercial building, real property is going to be depreciated over 39 years. Now with personal property, we're going to identify the personal property that can be on faster depreciation schedules that give the owner more depreciation up front that they can use to reduce their tax liability. So the way that played out with the developer when I met him this year is he told me he welded the shipping containers together. So that means that he didn't get as much tax benefit had he attached those shipping containers with nuts and bolts. He would have gotten significantly more assets that he could have depreciated faster. But since he welded them together, there was he still got a significant tax benefit from the study, but it would have been a lot more had he connected those shipping containers with nuts and bolts. But however, that may or may not have changed the design of the building, right? But like you were saying, if I'm brought in if I was brought in earlier, at least he would have known what type of tax benefit he would be receiving with a cost segregation study.
Yeah, that makes sense. Okay, so that probably was a non-issue when he was thinking about putting the building together, just because he didn't know. But that's really part of the benefit, that the value add that you bring is helping your clients understand, if there's a couple different ways to do things, what's the best way to do it from a tax liability standpoint. And when someone comes to you, Geraldine, so let's say, I have a tax issue, tax liability for next year or this project. So what does a consultation with you look like? What do you typically explain or lay out, or how do you, what do you share when someone comes to you and you're having that first meeting?
There's no cost to have a consultation with me.
Okay.
So even when we do provide an estimate, we provide an estimate to these potential clients at no cost, so that they can see what the numbers look like. We will have a conversation with the client and their CPA, because if the numbers make sense, then of course the CPA will recommend the study, and the real estate owner or the tenant that owns the improvements, if it makes sense to that potential client and their CPA, then they'll move forward. But it doesn't cost anything to have a consultation with me and for me to provide that estimate. And so when I talk to someone, we go over, what do they plan? Usually, one of the initial questions are going to be, what are their plans, right?
Mm-hmm.
Are they going to do a renovation, and also what are they looking for? Like, what is their need? And because a lot of times, let's say going back to a client that has a real estate portfolio, sometimes the CPAs won't share, what type of tax liability their client has, right? And and sometimes they'll just have me look at one building, even though I know they have multiple buildings in their portfolio.
Mm-hmm.
And so let's say we look at this one building and it looks like they'll receive $100,000 in tax benefit, right? The CPA will say, that's great, and we don't need to look at the other buildings. But it kind of gives me an idea on some level, what the tax liability they were looking at.
Okay, that makes sense. So they'll come in, a client will have a consultation with you. You might look at a part of their portfolio, or sometimes multiple buildings. And then when you're doing your engineering survey, how long does that take? What does the process look like?
Sure. So all of our work comes with an on-site inspection, because our study comes with what's called an audit defense. What that means is that if the client's ever audited, the client and their CPA don't have to worry about defending our report to the IRS agent. We'll be the ones to help the CPA field any questions about our report to the agent. Typically it takes about 30 days after the on-site inspection is done to get the report. However, my industry revolves around tax deadlines. So it's not unusual for a client or their CPA to reach out to me, let's say 2 weeks before the deadline. And that could be based on a number of things. They didn't get certain information from the client. And after working on their tax return, they saw that there was a need to have this study done. So in that case, we are able to take care of last minute cost segregation study requests, so that the client can take advantage of the benefit. And again, we'll work with the CPA and make sure that they have the information that they need in order to finish that tax return.
Got it. Okay. So if I'm hearing you correctly, it's about a 30-day lead time from the time you sit with someone till the time the report's created. Is that right?
No. It's 30 days from when the inspection is completed. So what I mean by that, let's say somebody talks to me today and I'm able to provide them an estimate, let's say this afternoon, and they decide that the numbers make sense and they want to engage my firm to do the study. So let's say the property is in Walnut Creek, which isn't far for my company to get someone out to do the inspection. And let's say we in an ideal world, we have somebody go out to do the inspection tomorrow, then it would be 30 days from tomorrow when we should have the report.
Got it. Okay. All right. So, so then is it fair to say maybe 45 to 60 days is a good lead time to plan for, to account for those extra steps? Or what do you typically tell people when they're coming to you and you know, for the process to complete?
Well, so one of my initial questions is going to be, when do you need the report?
Got it.
So let's say for the clients that I worked with this year, I would ask them, are they on extension?
Mm-hmm.
Or did they need it for the March or April deadline? So that's going to be initial question. When do they need it? And depending on when they need it, that'll determine how, when my team will get the report done. If they need it sooner than later, then we'll make sure to have that study done when they need it. But let's say I do have clients where they don't need, you know, they purchased property in 2020, right?
Okay.
Well, they're not going to need the report till next year, when their CPA is going to file their taxes. So it just depends on when they need that report.
Got it. Okay. So when you're speaking with them, you're identifying timelines and really taking a consultative approach to understand what's their timeline, what are they looking to accomplish, and then you'll kind of work with their schedule and make sure that you're helping them meet their goals. Is what you're doing?
Yes, absolutely.
Okay. And then you did mention you work closely with CPAs, so I would imagine you kind of follow their.
Yeah.
Is it usually a busy time during tax season? Yeah.
Yes. So when the CPAs are busy, I'm busy. So right now I'm busy towards the end of the year because a lot of clients and their CPAs do their tax planning, and then definitely I start to get busier in January, because then you get clients and their CPAs preparing for the March deadline. And definitely in February, you know, in March, we're slammed just because of the March and April deadlines. And then summer hits and we're still busy because then we're dealing with the September and October deadlines.
Wow. Okay. All right. So are there any projects that come to mind, kind of real world recent projects to help us understand, you know, the power of a cost segregation study?
Yes, you know,
what kind of projects have you been working on?
So a client that I recently met with, he has a portfolio of residential and commercial properties in the Bay Area. And what was music to my ears is he was telling me that he reached out to his CPA and said, okay, how much do I owe the IRS for 2019?
Okay.
And his CPA said, nothing. You had Geraldine and Veracity do the cost segregation study, so you owe the IRS nothing. And he was so happy about it. And so, I mean, it's always great to hear a client happy that they didn't have to pay the IRS and they thought it was worth it to do the study. And to give other recent examples, so I'll give 2 examples. 2 different clients of mine bought property. One bought a single family home in Calistoga that was going to be a rental. And then another client bought a commercial condo in San Jose. And both properties were over 900,000. Anyways, when I did the estimate, we were looking at for about a $5,000 fee. We estimated that, and we're always conservative, right? Because we don't want to overpromise and underdeliver. So we said it looked like, based on the type of buildings, it looked like we would save them, best case scenario, 100,000 in taxes.
Wow.
But after we did the study, we ended up actually saving them over 300,000 total in taxes. So the value proposition is, do you want to pay my company, let's say, anywhere from, you know, $4 to $5 grand for that type of property, or would you rather pay the IRS, you know, hundreds of thousands of dollars in taxes, right? So I mean, it's a no-brainer at that point because the fee's so minimal, you know, and they get so much tax benefit that they're happy that they got introduced to me and that I was able to do the study for them. Because there's a lot of people out there that still have never heard about cost segregation. That's why in the beginning I said I feel like it's great to educate people in the real estate space about this tax strategy that could possibly help them.
Yeah, that's pretty huge. Hundreds of thousands of dollars. Pay the IRS hundreds of thousands, or pay your firm a small fee. That's a no-brainer. And then I could see how that would definitely result in satisfied, happy clients. To get that news from the CPA saying, hey, you have zero tax liability this year because of what Geraldine was able to do. And, a lot of people that I talk to, they're more familiar with straight line depreciation. I think it's a lot easier to wrap your mind around that. But could you help us understand? So question that came in, what's the difference between what you're doing and the straight line depreciation method? So could you kind of help us understand how you're able to go from having that tax liability of a couple $100,000s potentially, and compressing that down and being able to write off so much?
Sure. So when you purchase a property, part of the purchase price goes to the building and part of it goes to the land. So now when we talk about the straight line depreciation, when we talk about depreciation, we have to take land out of the equation because land's not depreciable. So let's use an example of someone that purchases a property for $1 million. Let's say 800,000 of that goes to the building and the rest goes to the land. So 200,000 goes to the land. Now, without doing cost segregation study, what's going to happen is that building's going to be depreciated. Let's say it's a commercial property. So that building will be depreciated over 39 years. So if you divide 800,000 by 39 years, each year for the next 39 years, you have about 25,000 you can use to reduce your tax liability. And that's using that straight line depreciation method that you mentioned a second ago. Now, if you do a cost segregation study, what it does is it literally breaks out that building into all the components that were used to construct that building, right? The four walls, the roof, the flooring, the electrical, the plumbing. So so that's what the engineering study does. So after it breaks out the building into all those different components, you're going to end up with, if this property was purchased before September 27th, 2017, and then I'll explain more about that date in a second. Then you're going to have these components divided into 3 buckets. Personal property that can be depreciated faster in, let's say, 5 years. So anything inside the building, that could be, what we would be taking a look at would be, carpet or the flooring, the decorative lighting, certain portions of the electrical and the plumbing. Those we're going to be identifying personal property that can be depreciated over 5 years versus 39 years. And what that means is, instead of waiting 39 years to get all that depreciation, there's a significant amount of depreciation you can accelerate that you can use now versus having to wait that 39 years. And then outside the building, we're going to be looking at land improvements that can be depreciated over 15 years. And that would include things like wheel stops, bollards, asphalt, landscaping, things like that. So you're going to have these 3 buckets, components that can be depreciated over 5 years, 15 years, and then everything else is going to remain in 39 years. So basically, that 5 and 15-year assets that can be depreciated faster, you can choose to not be on a straight line depreciation method, and you can accelerate the depreciation on those assets that can be depreciated faster. So you can use more of that accelerated, you can use that accelerated depreciation now versus having to wait a long time in order to reduce your taxes.
That's pretty huge. So instead of waiting the 39 years, you can compress that or a portion of that down to 15 years or 5 years.
Right. And typically we can with a cost segregation study, it's anywhere between 20 to 40% that you can move to a faster depreciation schedule.
Got it. Okay. That's pretty huge. And then I did hear you talk about 2017. And so what happened in 2017? And could you expand on that a little bit more?
Sure. So the rules regarding bonus depreciation changed. What that means is if you purchased or constructed a property after September 20th, 2017, instead of looking at these 5 or 15-year buckets, you're just looking at a 1-year bucket. You can capture that accelerated depreciation in the first year. So bonus depreciation.
That's pretty huge. I think when I heard that, oh, go ahead.
Oh, no, go ahead, Dan.
No, I was just saying that's huge. When I heard that, it really got my attention because I had no idea. So, that goes kind of back to what you were saying earlier about knowing the tax law and how, if you don't know, you could be throwing, money in the garbage. And so that's pretty huge.
Yeah. And with the clients that I've been working with, right now, if they put a bid on a property, right, and in order to win, they're looking at paying more for that property. If they know about cost segregation, what they'll see if they have to pay more for that property is that, well, with the cost segregation study, they'll get all that tax benefit. They'll actually get more tax benefit just because they're paying more for that property. So that's how a lot of the clients that we work with think of paying more for a property, knowing that they're going to do a cost segregation study.
That makes sense. So if they know about cost segregation, it's a strategy that could impact the way that they're looking at property, and when they're doing their analysis, that's going to change things. So they could potentially take advantage of opportunities that they otherwise might pass up or miss out on.
Right.
Okay, makes sense. Okay, so if someone's watching this right now, how do they get started? What would you say to someone that's interested in doing a cost segregation study? Where do they start?
So other than the initial questions that we talked about, when do they need it and what are their plans with the property, if they're interested in seeing what the numbers look like, all they would need to do is just call or shoot me an email. And the information I would need is the address. If they purchase the property this year, I would need the closing statement. Also, I would need to know, sticking with that scenario, if it's a 2020 purchase, I would need to know from their CPA the allocation that they're going to use as far as the basis that's going to be used for the building and the land. The other question that I would ask is it part of a 1031 exchange? Because then I would need to know would need to know a couple of things about the relinquished property. Was a cost segregation study done on it? And what did it sell for? And so I would have questions about the 1031 exchange. Other than that, if it wasn't a purchase in 2020, I would need the depreciation schedule, because that's going to give me the building and land basis that the CPA is using. Also, it would tell me if, how much they did improvements, if they did any type of improvements to the property.
Got it. Okay. And is it pretty common to, do you hear more from individuals with the tax liability or from their CPAs, or is it kind of both, or who usually gets a hold of you when there's a tax problem?
So it's both. So with the clients that get referred to me, and it would be because they either saw me present, or they know someone that did a cost segregation study and benefited from it, and it recommended that they do it for their real estate. But I also do get contacted by CPAs, because when they're doing their client's taxes and they've done everything they could to reduce the tax liability, and it still looks like their client owes and they own real estate, or it's a tenant that owns improvements, then they'll call me and talk to me about doing a cost segregation study for their client, because they don't want to have that conversation with their client saying, well, you're going to have to write a check to the IRS.
Yeah, that makes sense. You're like a secret weapon in their back pocket that they can pull out.
Yeah.
Okay, so yeah, if you're watching this, if you might have a tax liability, for next year or whatever year, or if you're a CPA that has a client who might have a need, or if you're a broker, Geraldine is available. Her information is up on the screen right now, so jot that down, shoot her a call, give her an email, and she's happy to connect with you and see how she can help. What parting advice do you have? Anyone watching the show right now, what's any parting advice for them?
So the advice I would give is to not think that is to make the assumption that it may not work with them. A lot of people that I come across think that they have to have a property, that's large enough to justify a cost segregation study. So they feel like they must have have purchased a building for millions of dollars, and that's not the case. We say, we look at properties, that are, around 250,000, and we also have clients that have a portfolio of properties where they've bought out of state and they purchased these properties, let's say around 100,000. So, so it doesn't hurt to just take a look at the numbers. So, and for example, let's say somebody has a $50,000 tax liability, right? So it's best to just check and see what the numbers look like, because, with their property, if they were able to save 50,000, again, it goes back to what we talked about earlier. Would you rather pay a minimal fee so that you don't have to pay the IRS 50,000? So the advice I would give is, don't think that they have property that may be too small to take a look at. You never know.
That makes sense. Okay, so no property too small. There's no cost to reach out and get good information.
Right.
Very good. Okay. Well, Geraldine, thank you so much for your time today. I know I learned a lot. Just want to thank you for coming on the show and for everything that you shared today.
Thank you for having me.
What we're going to do is perfect. Thanks for coming. And then for everyone who's watching, what we're going to do, go to my website, dandelriel.com. We'll put some show notes, and if you want to catch the replay, that's a great place to go, so you can rewatch the show and also share it with anyone else who could benefit. So thanks everybody for joining us, and have a great day.
Thanks, Dan.
See you later.